So I thought we'd really kick things off with a discussion of what I think is probably at the forefront of a lot of different people's minds, namely the interest rate market and the bond market in particular. So first I thought I'd highlight a few of the views and the things that we hear from a variety of our clients whenever we talk about interest rates in the bond markets. And in general, we hear two things. And the first thing that we hear is, well, I really feel and I really fear that the Fed is going to start tightening. And the second thing we hear is that, well, clearly I don't want to own bonds because there's really nothing that can happen with interest rates other than going up. Really, there's only one direction that interest rates can go. And on both counts, we often find ourselves disagreeing with both of those points of view. So on the first, this idea that the Fed is about to start tightening, our view is that the Fed is not about to start tightening. The Fed has already started tightening. So the QE3 has been the longest tenured of the three quantitative easing programs. And the bond purchasing program, as many of you know, is expected to terminate here over the course of the next couple of months. Now, we've seen this show before, right? In the first round of quantitative easing and the second round of quantitative easing, the Fed was able to pull back that stimulus it was putting into the economy. But in this case, it's a little bit different, and it's a little bit different for a couple of reasons. And this is why we think this actually means we're tightening when pulling away QE1, QE2 really didn't feel that way. The first reason has to do with thinking about the US interest rate market not in isolation, but in comparison to what some of the other central banks in the world are doing. When you look at what the European Central Bank and then what the bank in Japan are doing, the policy of the United States on a relative basis is extremely tight. And that wasn't necessarily the case coming out of the first round of quantitative easing or the second round of quantitative easing. Now, I think the second thing that's kind of interesting and important, and we highlight it here on the chart, is the difference in the response in the shape of the yield curve. So what are we showing here on this chart? We've got three pieces of data. The jagged, I think, green line that you see that's been flat for the course of the last several years, well, that's the target rate from the Fed. What you see in the other two lines is really just a comparison of both the 5 and the 10-year yield to the long bond, the 30-year yield. And what we've really seen over the course of 2014 is that both the difference between the 5 and the 10-year and the 30-year bond have compressed pretty dramatically. And when you look historically, so looking at the last period before we really saw a rise in that target rate from the Fed, this really has acted as a leading indicator for understanding when the market believes that the Fed's likely to increase rates. So this more recent rise we see, we think is evidence of, yes, there is a likelihood being priced into the market that interest rates are expected to rise in the relatively near future. So that's interesting for interest rates, but it's also important for bonds as well. Remember that all of this implies that when you're buying a bond, you're buying in these expectations. So all of these expectations of a future rise in interest rates over the course of the next several years are already part of the price of the bond that you're buying. So whenever you think about, well, I don't really like this rising interest rate environment, that'll cause my bonds to go down, remember that that's already embedded in a lot of the expectations for the price. Now, on the complete opposite side of the spectrum, we look at China, which has been a market that really has been out of favor over the course of really the last 4 years, and it is the opposite story. So here on this chart, we show three lines. One, the blue line, just a measure of the return of the renminbi versus the US dollar. Here we're just using that as a proxy for what Chinese central banking policy looks like. The orange line is the relative return of the Hang Seng China Enterprise Index. It's what we think is really the best, most representative index of Chinese equities versus the S&P 500. And the green line is what China has said its year-over-year GDP growth is for whatever that's worth. So we see China as really having kind of been in a tightening phase since early 2010. And from that period through the end of 2013, Chinese equities underperformed the S&P 500 by a cumulative 83%. So this tightening that they've gone through has really had a magnificent impact on the markets. While when you really look at the GDP, which is that third line we show here, yes, things have tailed off a little bit in China, but it hasn't been all that dramatic. So in general, with a more recent shift in easing that you see there in the blue line kind of taking a tick down over the last 6 months or so, we have a relatively bullish view on China, I think, relative to a lot of our peers and a lot of our competitors. And over the next 3 to 5 years, I would say that view is not just with respect to China, but the emerging markets in general. Our point of view is that most of the emerging markets still trade relatively cheap. We do think that's where a lot of the growth is going to be. But most importantly, looking at, for example, 2013, when the S&P was up more than 30%, the MSCI Emerging Markets Index was actually negative. Emerging market stocks were down in a really bull market for equities elsewhere in the world. So from our perspective, the other interesting component to consider here is, even if you expect equities to do relatively poorly or to have a correction at some point in the next 3 to 5 years, we think that central banking policy in the developed world has disentangled that relationship between emerging and developed markets equities, so that while you would usually think, wow, US equities are correcting, emerging markets are going to be down even more, right? If the S&P is down 30, I expect emerging or higher risk equities to be down 40 or 45%. We think that relationship is less strong than it's been in the past. So our view of positive exposure to emerging markets over the 3 to 5 year time frame is still there and still valid for that point of view. But jumping back to interest rates, what we hear more than anything else is that interest rates can't go anywhere but up. Now, of course, what we show on this chart is that in 1994, interest rates couldn't go anywhere but up. We also show that in 1998, interest rates couldn't go anywhere but up. And then in 2003, you would have read newspapers, articles that said interest rates couldn't go anywhere but up. And every smart investor in 2009 knew that interest rates couldn't go anywhere but up. And all of those people who knew that interest rates couldn't go up missed out on really attractive risk-adjusted returns for US Treasury bonds. So in all of these cases, the bonds had really strong risk-adjusted returns. Is that likely to continue? Is the case different now? Yes, it is a little bit different now, and it's different for one main reason. The main reason is that when your starting yield is higher, more of your return is coming from the fact that you're actually earning a yield on the bond that you hold, and a little less of it is coming from your exposure to changes in interest rates. So starting from a lower base, it's a little harder to get that 60 or 80% kind of cumulative return on a bond when you're starting from 2.43%. But having a long-term view that interest rates will rise is not necessarily wrong. And in fact, if you extend the time horizon long enough, we think it's a practical certainty. But betting that interest rates can only go up in the short run as they move higher in the long run, we think is anything from a sure bet. Now, one of the reasons we think that is because of what we know about other Treasury markets. So what we show here are the yields on the 10-year bond for both the United States and German bunds. The most important thing to highlight here is looking really since the global financial crisis, which is this last maybe 15% of the chart. Really, bunds and the US Treasury moved in lockstep. From the beginning of the global financial crisis to a little over a year ago, you really got paid the same amount for holding debt issued by both Germany and the United States. But they've since diverged dramatically. The yield on the 10-year German bund is less than 1%. So we think a range-bound US Treasury between 2 and 3% in context of what we see other bonds yielding around the world is actually pretty reasonable. And if you asked us, we would say it's probably closer to 2% than to 3%. And I wouldn't be too quick to bet against a sub-2% Treasury. Now, I think this is more important than just betting on the direction of interest rates, especially as we think about building portfolios. So at Salient, we really don't believe in the idea of crystal balls, about believing that you have to be able to predict where the market's going to be a successful investor. But we do believe that most investors are far too heavily positioned in equity market exposure. So a traditional benchmark exposure of 60-40, a balanced type allocation, we think more than 90% of the risk of that is driven by an investor's allocation to equities. Treasury bonds really are that one diversifier in a portfolio of a lot of different things that look a lot like the stock market, and a lot of different things that are impacted by economic growth. When Lee Partridge, our CIO, and I were at Texas Teachers, we were part of an institution that had a pretty strong commitment to Treasury bonds. And one of the realizations I think we came to, and that the fund came to in 2008, was that there were really only 1 or 2 assets in the entire world. Emerging markets, US markets, international markets, from equity to credit to fixed income to private equity. There were really only 1 or 2 markets that you could invest in that actually did well in 2008. And US Treasury bonds were one of those exposures. So We think that the diversification power of these bonds means you have to have a very, very strong negative view at a portfolio level to justify pulling the exposure back a lot. So ending this sort of diatribe against the rising interest rate scenario, I guess my admonition would be one thing as investors: consider, if you have a strong rising interest rate view, whether the better way to express that would be through increasing your exposure to inflation-sensitive assets rather than reducing your exposure to U.S. Treasury bonds. Many of us in the room already have a lot of implicit or embedded exposure to commodity-sensitive assets and income through oil and gas, or even the fact that we live in Houston. And I think that provides a pretty strong justification for maintaining maybe a higher bond allocation than we might otherwise. So that's our point of view on rates. Jumping over to equity markets, I thought I'd digress a little bit here and talk about what our investors, our partners are saying about this. And at Salient, we manage money for individual clients, for family offices, small institutions, large institutions, and we have a lot of partnerships with other investment firms as well. And it doesn't really matter who we talk to, because we hear the same thing on equities as well. No one is excited about equities. Anyone we talk to, the best you're likely to get is, well, you have been kind of on a run for some period of time, but I'm staying invested. No one really has that level of strong conviction. What's really interesting in the paradox is that equities continue to go up. So why is that? Well, we see it as kind of a tale of two investors who we're going to introduce here in just a moment. But I want to introduce a little bit more evidence of what I'm talking about here first. So what you see on the left side of the chart, I would characterize as high-level macro-based considerations of how equities have done on a year-to-date basis. In the upper left chart, you can see U.S. stocks, international stocks, emerging market stocks. They've all kind of gone up around the same amount. It's not big differences in the returns of different equity asset classes. On the bottom left, we show different investment styles, and this is in the U.S. Value investors, growth investors, core strategy investors, all of these things have kind of moved up together. So anything that's really at a high level, macro-driven, driven by allocation, is up kind of around the same amount. But when you look on the right chart, you see a very different story. And the story we see on the right chart is that by sector, stocks have done very, very differently, and it's actually fairly counterintuitive. So what are the best performing sectors in the US on a year-to-date basis? Well, if I told you the stock market was up on pace to be up 15 to 20% on a year-to-date basis, you would probably tell me, well, it's probably your cyclicals, your higher beta, your higher risk stocks. Well, it's not. The sectors that are performing best are healthcare, it's energy, it's utilities. The stocks that are performing most poorly are industrials. It's consumer discretionary stocks. You really rarely see an environment like we're seeing right now where the stock market is up a fair amount, but underneath the market, it's the lower risk stocks, the more defensive sectors that are doing well. We see this on the next page as well. What we show here is the performance of the S&P 500 on a year-to-date basis, separated into quintiles by beta. So the far left is your 20% of the riskiest stocks in the S&P 500. The far right is the 20% of the least risky stocks in the S&P 500. And it isn't the case that the highest beta, riskiest stocks have done well, but it also isn't the case that the most defensive stocks have done the best. The truth is that it's the stocks in the middle which are doing most poorly. The highest beta, highest risk stocks, and the lowest beta, lowest risk stocks are the ones that are outperforming. So why is this happening? We think the market's expressing bimodality. On the one hand, the macro players, the guys who are following the central bank, the guys who are following trends, think global macro hedge funds, think CTAs and trend following strategies. They're bidding up equity prices, and whenever there's a little bit of softness like we saw in July, they're providing the bid. They're stepping in there to make sure that correction for strong geopolitical concerns is only 3 or 4%, not 15, 18, or 20%. On the other hand, are the stock pickers, the fundamental investors who are looking at the economy, looking at companies and saying, I'm not all that excited about this. And they're the ones who are positioning themselves rather bearishly. So why does this matter? Well, imagine what happens when the market's direction, the price of every security we're buying, is determined by two diametrically opposed views. It's not as though everyone kind of averages to a general view on the market. No, the average view of the market is the average of two very different views that different types of investors have. So the other implication of this is, well, what happens if one of those views dissolves? What happens if the trend dissolves? Or what happens if fundamentals really go off the cliff? Well, what happens is that when that dissolves, the market can move to that one remaining consensus point of view quite quickly. So we're not bears on equities. Actually, we have a pretty positive view, and we think that things are going reasonably well, but we're cautious about the potential for volatility to creep back into the market relatively quickly. I think the one thing we want to highlight in addition to equities before we wrap up is just a little bit of a review of the labor market again. I think a lot of you have probably seen this chart before, but I think it's always worth reiterating. Our view is that since 2009, the actual number of people who are of working age, who are actually working, has remained absolutely unchanged. So when you look at this chart, what you're seeing is that the drop in unemployment is almost 100% driven by an increase in non-participation in the labor force. People who are saying, I don't want to work anymore, I can't find a job, or to a lesser extent, people who have had the opportunity to retire early. So I think this has some economic considerations. We actually think some of the political considerations are more interesting. So the other chart that we don't have here, but which you might have seen elsewhere, is the share of the national income that's going to labor. We are at all-time highs in terms of the amount of national income that's going to corporations and to capital, and all-time lows in terms of the amount of that income that's going to labor. So what we see, and we'll highlight this on the takeaways here, is a real risk that populist policies could really start to lead to both taxation and some limitations on the ability of companies to generate those same levels of profitability. So that has implication across equity markets, fixed income markets, and we think those are all pretty important considerations. We also think that while tightening has begun, there are a lot of different scenarios, a lot of potential outcomes for Treasury bonds. Getting back to the 10% level on the 10-year Treasury bond is absolutely a possibility. So we think betting on there being no case but interest rates going up is a losing battle in our view. Second, while we're not bearish on equities, we do think they're being priced as a house divided. And investors should be very cautious and be very aware that the volatility in equity markets, which is historically very, very, very low versus what we've seen in the long term, that volatility could creep back to the market very, very quickly if one of those two narratives breaks down. And I think we didn't spend a lot of time on this point in particular, but we do think, as you think about your views on having U.S. interest rate exposure, equity exposure, that has to be considered in context of what's going on in the rest of the world. Yes, U.S. interest rates are low, but compared to Germany, compared to Japan, we are tightening. We are already much higher in our interest rate environment than what we're seeing in those other markets. Yes, credit does appear to be a little freer, and I think Paul will talk about this as well. It does appear to be a little freer than it's been in the past. But when you look at some other markets and the balance sheet of for example, the ECB, we think that it's not nearly the problem in the United States that it is in other markets. I think the last point I would make is that we're looking at, I think, the geopolitical risks we see right now, and historically, 5, 7, 10 years ago, the number of different events we're seeing would have led to a much more significant correction in most of the risky assets that we're seeing. To have only seen about a 4% peak to trough correction in the S&P 500, given everything that was going on, very, very surprising. We think that central bank suppression of volatility is a big reason for that. And as that punch bowl gets taken away over the course of the next couple of months, be more mindful, I think, than we've had to be in the last couple of months of some of those geopolitical risks. And as I was expressing to some of the other people at the table, we know some of these views fall a little bit outside of the mainstream. We think one of the great things about being a money manager here in Houston, I think many of you will identify with this with your own businesses as well, is that we don't have to have the same views that we have, that everyone in New York, everyone in San Francisco in the investment field has. We can be a little bit different. We think that's a good thing. So, Stemo, appreciate it.